Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Christopher Aaron, founder of iGold Advisor and senior editor at the Gold Eagle website. And Christopher, always great to have you on the show to get an update on how you're looking at things technically and fundamentally. It's been a while. We haven't chatted since April, so we've had a good chunk of time here to see things change in the precious metal sector. And we were remarking off mic that I don't think we would have expected sentiment to be as poor in the sector as it is, considering gold was just up, piercing new all-time highs, really just a few weeks back and a few months back, up over 2,500. The question I have for you to kick things off today, though, is a lot of this was being front-run and anticipated by the markets because people know that eventually the Fed is going to start cutting rates, just like other central banks have started. And a lot of people looking to the September meeting for that to kick off. At this point, where gold has already made such a big run, and some of that was a huge factor behind it, the anticipated easing cycle. Has it already been priced in, or do you think when the rate hikes start that that's another leg higher? How are you looking at the price action versus the expectation?
Yeah, Shad, thanks so much for having me back on the show. When we look at Fed rate probabilities themselves, we can look at Fed futures. This is the literal market that is betting on whether or not the Fed is going to cut or how much they're going to cut. At this point, we have the highest probability coming up in September of two interest rate cuts. In other words, half a percentage point coming up in September, then another cut in November, another cut in December, basically cutting all the way out here over the next year. So, and we have to remember that this information is public and all markets are interrelated. All markets are observing what's happening in other markets. And so the net takeaway is yes, the markets have already priced in as a net sum rate cuts coming up, including the one in September and including the ones going out for the next year. So, if the futures market has priced in the rate cuts, we better believe that the US dollar has priced in the rate cuts. We better believe that bond markets and precious metals markets have priced in the rate cuts. Yes, indeed.
Well, when you look at the price action in gold, it has been constructive, and the chart's actually a beautiful thing with gold. You've got a pattern of higher highs, you've got a pattern of higher lows, you've got a respect to the moving averages. It's held the 50-day moving average, for an example, as a line of support, and it looks pretty solid. I guess my question would be, what is the catalyst to keep it moving higher? Can it keep moving higher? Is it in any danger of breaking down? How are you looking at gold technically?
Yeah, so let's go back. I actually want to rewind, and listeners can verify this. I want to go back to 2015, the last major bottom that the precious metals made, price of gold made. It was December of 2015. Gold had been falling for nearly 5 years. It had lost 45% of its value. From 2011, gold was above 1900, and by 2015, it had fallen down to just above 1,000. So gold had lost nearly 50% of its value in 5 years. And what was looming? The first interest rate hike, the first hike in a decade, the first time that the Federal Reserve was going to hike interest rates. And the entire market knew that this was coming. And everyone was saying, you got to sell your gold now, you got to sell your precious metals because the Fed is about to start hiking and higher interest rates are bad for gold. This was the prevailing wisdom around the world and with the entire gold market at the time in 2015. And I took a step back and I just started saying, yeah, that's one narrative. But what if I actually just look at the gold chart itself? What if I tune out that story because that's only one story? There's other stories going on as well. There's buying coming out of India and China. There are people that are looking at maybe a recession happening in the United States, right? There are thousands of different stories playing into the gold market. So if we're only keying on interest rates, that's only one of the factors impacting gold. I took a step back in 2015, and listeners can verify this if they want to. If they want to see that I'm not making this up, they can go to my YouTube channel, they can go over to Gold Eagle and look at the articles that I began publishing in late 2015. And I was saying at the time, there's a pretty strong chance that as the Fed hikes, as they do this first rate hike in over a decade, that gold is actually going to bottom and start moving higher in exact contrast to what the market thinks it's going to do. And so I would encourage listeners to go do that, to see that I'm not making this up. And what happened then? December 2015 was the major low, literally 48 hours after the Federal Reserve hiked interest rates for the first time in a decade. That's when gold bottomed. It didn't look back. $1,000 per ounce. We're now nearly 150% higher in the price of gold here just a few years later. So that was a major bottom for the price of gold. And it happened exactly opposite how most people expected it to. And we've got to think about the reasons why this happens. I mean, this happens because what we were discussing, Shad, just a few moments ago, which is that the markets price thing in ahead of time. And so ironically, when the actual thing happens, in that case, the rate hike, or in this case, coming up, the rate cut, it's already priced in. And so sometimes you have the last little gasp of buying or selling, depending on whichever way the market is moving, sort of the final tranche of traders saying, okay, the event finally happened, the rate hike or the rate cut finally happened, let's act on that. But generally speaking, those are the absolute laggards to act on the news, which is already priced into the market. So if that was a major low, and we're talking now 9 years ago, 2015, if that was a major low, and here we are setting up 9 years later, gold is 150% higher. Gold has just hit new all-time highs as of 2 weeks ago. At the very least, we can say this is not a major low. You know, if we have three categories, one being major low, one being continuation, and one being top, we can at least eliminate the category of major low. We know that making new all-time highs is not a major low. So, therefore, we're in a bit of a shaky situation here for the precious metals. I want to be fully transparent about that. I'm seeing a lot of mixed signals, and I'm seeing a lot of investors right now saying that because the Fed is about to cut rates, therefore, precious metals are going to keep moving higher. And I'm preparing to take, not maybe the exact day, but in this window of time, I'm prepared to take what looks to be like a contrary opinion, which is to say that I actually think we are closer to, I don't want to say the ultimate top, but let's say a multi-year top in precious metals and in the price of gold coming in the window, not maybe the exact day, but in the window of this first rate cut that is coming up. And I have a lot of evidence for that. Gold price itself is strong, but we have a lot of evidence when we're talking about other aspects of the market. And so I would just say to investors right now, and remember, this is not to say that I don't believe in gold. I love gold. I think gold should be the basis of the monetary system around the world. I think we should go back to a strong currency backed by gold. I think we should abolish central banks around the world. I think a sound monetary system is essential. But I'm also a realist. I look at the charts. I look at what's going on around the world. Nothing moves in a straight line. We've had higher gold prices for the last 9 years. Is there perhaps not something cyclical setting up in the opposite direction at, ironically, the moment when most investors expect the first rate cut to send a new launching pad higher?
Christopher, that is an interesting kind of contrarian viewpoint to have. And yeah, I don't think anybody should question your love of gold. You work for iGold Advisor
Yeah,
and Gold
exactly.
Eagle. So not hating on the precious metals, just looking at the charts and what you see. But I mean, I would ask you, how do some of the other aspects of the precious metal sector play into this? Because we haven't seen GDX or SIL or SILJ really break out as much as people would have expected, considering the higher metals prices. And we've just seen silver, that was outperforming for a while, fall out of bed and really lose a lot of the momentum just in the last couple of months. So how are you looking at the other components of the precious metal sector in relation to gold?
Yeah, and this is one of the advantages that we have as precious metals investors is to look at other components. We don't have to only focus on gold itself. We can look at how related aspects are working. And this is where I am having a lot of caution flags that are waving on my screens right now as far as what the markets are doing. Let's talk about a few of them. If we think about the gold miners, we can talk about the GDX, which is the Senior Gold Miners Fund. but we could also talk about individual miners. The miners generally trade as a leveraged form of gold. I think everyone can agree on that. Typically, when gold is higher, by 5%, the miners are going to be higher by 8 or 10%. Same thing on the downside. The miners trade as leveraged forms of gold. The other thing that trades as a leveraged form of gold is silver bullion. We often see gold higher by 1 or 2% in a day, and silver will be higher by 3 or 4%. So both the gold miners and silver tend to trade as leveraged forms of gold. Now, a couple of weeks ago, I was looking at a divergence here where we had literally on the week that gold was making a new all-time high above 2,500 in the futures market. That exact same week, silver was breaking down. It was failing to hold the $30 mark. This was just 3 weeks ago. This is the third week of July. Silver was failing to hold the $30 mark in the same trading week that gold was making a new all-time high. And that was a major negative divergence for the entire sector. I mean, there's no good reason in a healthy market. There's no good reason. We could talk about silver just needing to consolidate, just maybe it's not ready to move higher. It needs to move sideways. That's fine. But silver shouldn't be breaking downward the same week that gold is breaking upward to a new all-time high. That shouldn't have been happening. So, and right now, as we're talking, silver is down in the mid 27s. $30 for silver was the clear horizontal resistance going all the way back to 2020. 30 was analogous compared to where 2075 was from gold, the 2020 peak. So this is a warning signal. We had silver spend a few weeks above 30 and it just collapsed over the last 3 or 4 weeks. And we have all these things going on in the world to explain this. We have the yen carry trade that's blowing up in front of our eyes. We have soft economic data, perhaps a recession coming in the United States. We also had some comments about 3 weeks ago from both current President Biden and former President Trump talking about sanctions on Taiwan or perhaps limiting the export of technology to China. And as we know, silver is still to this day an 80% industrial metal. And if in the primary use for silver is in electronics. And so if there's going to be a slowdown in the electronics component of the industrial demand, which is the largest component of silver usage to this day, there's going to be a slowdown in the silver price. So we've had all these things going on around the world. We've had wars and rumors of wars. And of course, we know in war, gold tends to be the primary beneficiary. Silver, not quite as much in the initial phases. Why? Because what happens in a war, things get blown up. Industry gets blown up. And in that instance, when there's a slowdown in the initial part of war, if these wars are to escalate, it's not until the rebuilding process, which can be a few years later, when the wheels of industry get turning again, that all that silver gets consumed. So we have like 3 or 4 reasons why we're seeing on the chart what we're seeing, which is this relative weakness for silver. And as a net sum, that casts a shadow of doubt here on the sustainability, let's call it over the intermediate term, for the entire precious metals complex. So, what I'm telling to some of my subscribers is not that they have to sell 100% of their gold or silver or their miners, but that it looks like at the best, it looks like silver needs to consolidate more. And when I look at the long-term silver chart, I will tell you, although we've had a bounce in the low 26s over the last day or so, I will tell you the strong support for silver is down in the mid 23s. So look, I mean, that's not the end of the world. Silver has already come down $5 from its peak. I'm saying the strong support exists about $4 lower than where silver is right now. I think the bigger picture thing, though, is that the failure to hold 30 and then what you were alluding to, Shad, has caused a break upward in the gold to silver ratio back up to 88 as we're speaking. It was all the way down at 73 a few weeks ago. That failure by silver and that break upward in the gold to silver ratio is telling us that we are entering a deflationary period in the world economy. We already talked about all the reasons why that could be happening. Wars are deflationary at the onset, and they're inflationary in the rebuilding part. Slowdown in the United States, deleveraging in Japan, sanctions against Taiwan and China, perhaps. All these reasons are showing us that we're entering a period of time. This could be 6 to 12 to 18 months. Sometimes these periods are a year or two. I don't think this is going to be for the next decade, but it looks like what silver is going to need to do is consolidate, and probably consolidate lower into the later part of this year, 2025. And then we can see, do we pass this deflationary period? Does the inflation start to roar its head again? If investors will simply take a thought and a step back and think about the last major multi-year deflationary periods that we've seen in the United States, you think about the bursting of the NASDAQ bubble, 2000 to 2003, silver didn't move higher that entire time. It wasn't until 2003, after the stock market bottomed, that silver began to move higher. Gold moved higher that entire time, but not silver. We think about the global financial crisis, silver fell more than the stock market in the actual global financial crisis. Same thing in the coronavirus little mini crash right there. So the best environment for silver and the mining sector is not to see the global economy crashing. It's to see stability in the global economy with a high level of inflation. So the wheels of industry consume that 80% of silver, but everything's stable. People are not panicking. And then the marginal demand for silver from protection for the inflation, that comes in, and there's only 20% of the silver left to buy. That's only 200 million ounces per year. I mean, you think about that. That's not enough silver for every man, woman, and child in the United States to even buy 1 ounce of silver per year, let alone demand in China and around the world. That's what we need to see for silver. We don't have that backdrop right now. And so I am cautious here on silver. I'm cautious on the entire sector for the next 6 to 12 months. And then I need to see, does industry stabilize? Does the world stabilize on all these fronts to say, hey, we could then be ready for that major leg up again?
Yeah, Christopher, it's an interesting backdrop with the macro side of it, setting up more to, like you're saying, a deflationary scenario instead of an inflationary scenario. It does make me wonder. We have a lot of people that come on and say that they'd like to see the markets correct for whatever reason, because it would bring more attention to the safe haven of gold and then eventually to the precious metal sector, to silver being poor man's gold, and then the gold and silver stocks. In this kind of an environment, I know you track ratio charts sometimes and you look at how is gold doing versus US equities. I would imagine that things have been rather flat because they've both been going up in tandem, even though gold's going up to new all-time highs. Look at what happened in the tech sector with the Nvidia and Google and Facebook and everything racing higher. And when you look at what happened in the indexes, the S&P and the Dow, they've been breaking out. Even some of the small caps finally got some life. But when you look at the major indexes, they've been going higher in tandem with gold going higher. So do we need to see something change on the ratio of gold versus US equities?
Yeah, I mean, this would be the big point for seeing more enthusiasm coming into the precious metal sector. Over the last 9 years, since that major bottom that we talked about in 2015, we've only seen these brief windows. There was about a 5 month window in 2016 where there was some enthusiasm. And there was about a 3 to 4 month window in 2020 where there was some enthusiasm. And then this year, we had, maybe a 2 month window, call it March and April, maybe into the first half of May, where there was some enthusiasm in the sector. And the primary reason for that, Shad, just to quantify, you already gave the fundamental, but just to quantify it as far as numbers and specific markets that I'm observing, I follow the Dow to gold ratio. The Dow is the longest dated stock index that we have in the United States. It goes back to the 1800s. We have analogs that go back to the 1700s for individual companies. And of course, we have gold price going back 5,000 years. So we can do a lot of good ratio analysis when we study the Dow versus the gold, the longest dated industrial index in the world versus the longest dated store of wealth in the world. And the amazing thing is that over the last 4 months, think about all the insane things that have happened over the last 4 months. We've had this deleveraging, Japanese stock market down 25% in 1 week, deleveraging out of Japan. We've had an assassination attempt on former President Trump. We've had current president drop out of the race, major shakeups on the political front. We've had wars escalating. We've had a direct attack by Israel on the soil of Iran, Israel launching bombs in Iran. And as we're speaking here today, Thursday, we are literally waiting. It could be any day now that Iran launches missiles back on Israel. All these things have happened over the last 4 months, and the relationship between Dow and gold is 100% flat that entire period of time. So there has been no net outperformance from either the ultimate safe haven or the ultimate industrial index with all these things going on around the world. I mean, I think we really need to step back and think about that for a minute. The market is treating industrial assets and safe haven, gold, to be functionally equivalent, functionally the same asset class. Yes, certain weeks we see gold outperforming the Dow by a percentage point or so. Other weeks we see the Dow outperforming. But you look back at it over the last 4 months, completely flat. The crazy thing is, if you actually extend it back to that major low in 2015 that we were talking about a moment ago, the flat line in the Dow to gold ratio actually goes all the way back to then. So as the price of gold is up nearly 150% over the last 9 years, so is the Dow. The Dow is also up 150% approximately over the last 9 years. This has never happened before. We have never had a bull market in the price of gold. Anyone saying that gold rising by 150% in 9 years is not a bull market in dollar terms, then I don't know what a bull market is. People buy and sell around the world gold in US dollars, up a double and a half in 9 years, but no change versus the relationship with the Dow in the industrial economy. So this is a huge historical anomaly that we are living through. It will be decided at some point. The pattern that I'm watching is a converging triangle that has an apex in 2027. But typically, these triangle patterns do not wait to the absolute apex to resolve strongly in one direction or the other. Typically, they'll resolve before the apex is reached. So that could be any day now. That could be in early 2025. I expect this thing to resolve strongly in one direction or the other. But it's this net flat performance in gold versus industrial stocks that explains to us why there has been so little enthusiasm in the sector. You know, we talked about it a few moments ago, why the price of silver, which is basically leveraged gold, why it's been struggling so much, and why the gold miners, which are also basically leveraged gold, have been struggling so much. It's because the mainstream investor that in previous cycles, we could talk about 2000, 2011, we could talk about the 1970s cycle. In those cycles, the mainstream investor would have done much better in gold than industrial stocks. That has not been the case in this cycle. And so there's just very little enthusiasm in this cycle. So what I'm going to say is we should have a resolution to this Dow to gold question. I mean, absolute latest 2027, but I think it's coming within the next 12 to 24 months. And that is going to be the single most important macro signal for investors to align with. I'm talking about for a decade or two. I'm not exaggerating on that signal. It tends to be when we see these major macro cycles in the Dow to gold, it sets the stage for 1 to 2 decades of outperformance. If we see that break downward, which would mean in favor of gold, then that's where I would be willing to say, hey, Shad, this conversation that we've just had where I said I'm cautious on the precious metals here, maybe we're going to form a top after the rate hike. If we see that ratio break lower, that's where I reserve the right to change my opinion. Why can't I do that? Why can't, as a human being, when the facts change, I change my opinion? And that could be the signal. That could then be where we do see gold over the next decade or two move up to 3,000, 5,000, 10,000, some of these numbers. But if we see that ratio breaking upward in favor of the Dow Jones, that's where, as an investor, I'm an investor ultimately. I've been aligned with the precious metals for a lot of the last 15 years because it's been a very good trade. It's been a very good sector to be in. When I started in 2007, that cycle to 2011, I really changed my life investing in that sector. And then it's been a good trade overall since 2015. But if the market is going to show me that the Dow is going to break upward versus gold here over the next year or two, I will not be investing in precious metals probably for a decade or two. Aside from my core holding of physical bullion, that is basically an emergency savings account, the way that I see it, a savings account that can't be debased. But as far as my assets go, I will be investing in industrial related stocks, technology, and also the commodities that are most needed by industry. So I suggest that investors follow this Dow to gold ratio, basically the most important thing to follow right now in the entire capital markets.
Well, I think we'll wrap it up on that note because it's a big picture idea. It's not imminent, like it's not tomorrow, but it's something in the next, like you say, 12 to 24 months that will be playing out, and we'll see which way the ratio breaks. Does it break in favor of the precious metals to outperform for a decade, or does it break in favor of the Dow to outperform for a decade? And people can make their decisions at that point in time when they have a more clear picture of what the longer term looks like. In the short term, it's sure not been boring. It's been pretty wild and pretty volatile in silver and in the stocks. Gold's been a little bit more stable, but we may be getting near that tipping point, as you pointed out, in the short term, just based on the rate cutting cycle starting in a couple months. So we'll have to keep tabs on that. We'll definitely have you back on the show in a short amount of time, like in a month or two, to give us an update. Maybe we'll do it around September when the rate cuts finally come, Christopher. And it's always great getting your thoughts on the KE report. If other people want to follow along with Christopher's thoughts, definitely click on the links below this interview. It takes you over to iGold Advisor and also takes you over to the Gold Eagle website. And as always, looking forward to our next conversation.
Thank you so much, Chad, and all the best to the listeners.